This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 29 of Value Investing. On today's show, what I'm going to do is I'm going to talk about another great value investor, Peter Lynch. He was mutual fund manager, and as the manager of the Magellan Fund, Peter Lynch was able to average a 29.2% annual return, consistently more than doubling the S&P 500 market index, making it the best performing mutual fund in the world. During his tenure, assets under management increased from $18 million to $14 billion. He is one of the best and legendary value investors out there, along with Warren Buffett. So I'm so excited to cover Peter Lynch over the next several episodes. So what I'm going to do in today's episode is I'm going to go over some content in his book, Beating the Street. So that's the title of his book. And at the end of the book, he laid out 25 golden rules of investing. So what I can cover in this episode is the first 9 rules that he mentioned in his book. And for the rest of the rules, I'm going to go over them over the next 2 episodes. And after that, I'm going to cover some of his investing techniques that he used in order to identify undervalued investment opportunities. If you're interested in buying and reading this book, I'm going to put the link in the show notes so that you can go to Amazon and buy the book. The book price is quite affordable. Before we get started, let me give you a disclaimer that this podcast is for entertainment purpose only, and it is your responsibility to consult with your investment professional for any investment decisions. Additionally, I just wanted to give special thanks to Lucas Opitz, who made a donation to this podcast through the link in the show note. Thank you. So without further ado, why don't we get started? Okay, so the first rule is investing is fun, exciting, and dangerous if you don't do any work. So let's just think about what he's trying to say here. He's basically saying that investing can become speculation or gambling if you don't do any work. So as an investor, and especially as a value investor, if you want to invest your money wisely in the long term, you have to do your own homework. You have to know what the business is like and how the company is making money. And you have to do investigative work before you make an investment decision. What's quite interesting is that a lot of people do a lot of homework before they buy fridge, microwave, laptop, whatever it is they buy. They do a lot of homework and try to find out the best product possible at the reasonable price. But when it comes to investing, people just tend to just invest money without doing a lot of work in terms of what company they're trying to buy. So that doesn't make any sense. So Peter Lynch is basically saying that you have to do your own homework before you're making an investment decision. That's the common sense, and I hope that everyone follows his advice. But in some cases, stock market can become casino, gambling house, because the price moves up and down every day, and people just treat stock market as casino, and they're just having fun. And ultimately, that's not really good strategy if you want to make money in the stock market. The second rule is your investor's edge is not something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies and industries you already understand. This is quite similar to circle of confidence concept from Warren Buffett, but basically Peter Lynch has been telling people that amateur investors can definitely outperform Wall Street professionals because, for example, if you're in credit card industry, you know how the credit card industry is working and what kind of companies are emerging within this industry, and you have upper hand compared to Wall Street analysts or hedge fund investors in terms of who's going to be the winner, and you know early on that who's gaining market share and so on and so forth. So you have huge advantage over Wall Street experts in your industry area. That's what Peter Lynch is trying to say. You can beat the market. You can beat Wall Street experts by leveraging whatever knowledge that you already have. Whether you're working in credit card industry, banking industry, some other technology industry, you already have the upper hand in terms of knowledge, in terms of what's trending up and what's trending down. And those things are very important piece of information if you're trying to make successful investment over the long term. So that's what Peter Lynch is trying to say in this second rule. Third rule is over the past 3 decades, the stock market has come to be dominated by a herd of professional investors. Contrary to popular belief, this makes it easier for the amateur investor. You can beat the market by ignoring the herd. This is also kind of aligned with what Warren Buffett is saying. Basically, Warren Buffett said that when the market is fearful, you have to be greedy, and when the market is greedy, you have to be fearful. If you purely follow the overall market crowd, if you have herd mentality, and if you don't become contrarian investor, then you're not going to be able to make the money in the market. There's a strategy called momentum investing where you're trying to follow herd mentality, but that's not the way you make money as a value investor. If you want to become successful value investor, you have to implement contrarian view in the market, and when things are really bad and when there's a lot of blood in the street, you have to have the courage to make big investment against the herd and make money off of it. And it's possible that the herd might be right because in many cases they are correct. However, if you make objective assessment and derive conclusion that the herd is not assessing the situation correctly, and if you go against the herd by having some courage to invest some significant portion of your money in the stock market, then that's the formula that you can adapt to make money in the market. And it's definitely not easy because people usually are not comfortable to go against the crowd. People usually want to follow what other people are doing because that's just the way human beings are designed. But if you're a contrarian investor, then you should have that courage and you need to know how to have this objective assessment in this individual stocks or in the market. Okay, so let's move on to the next rule. So next rule says, behind every stock is a company. Find out what it's doing. It's a very simple rule, but people ignore this on a lot. So every piece of stock that you buy, you're buying a piece of company. And this is the advice that Ben Graham gave to Warren Buffett and Warren Buffett gave to a lot of people. But people tend to forget how important it is to do the research on the company behind the stock. So when you're trying to buy Microsoft, for example, you have to do some research on Microsoft. And if you want to buy Apple stock, then you have to do research on Apple stock. And that's important because over the long term, if these companies do well, the stock price is going to follow. On a daily basis, you're not going to see the correlation, but you're going to see high correlation between stocks and the company's success, which is a good segue into the next rule, because the next rule says often there's no correlation between the success of a company's operations and the success of its stock over a few months or even a few years. In the long term, there is 100% correlation between the success of the company and the success of its stock. This disparity is the key to making money. It pays to be patient and to own successful companies. So this rule clearly says that there is a 100% correlation between the success of the company and the success of its stock over the long term. And in the short term, there's going to be a lot of discrepancies between intrinsic value and the stock price. And that's where you can make a lot of money. If the market behaves irrationally for certain individual companies, then you can take advantage of that if you have good knowledge. If you think that the fundamentals are strong, and if the market is overreacting to certain scandals that have happened in this company, then you can jump in and buy the company when things look bad from other people's perspective. But if you believe that the core business still is intact, and if you believe that the company is going to come out strong later after the scandal, then that's the really great opportunity for you to buy and jump in when you're making your investment decision. And as Peter Lynch said, the discrepancy can go as long as a few years. But over the long term, over 5 years, there's 100% correlation between the success of the company and the success of its stocks. So just be patient. So Warren Buffett used to say that what it takes to become successful in the stock market is not your IQ. It's your temperament. So if you're a type of person who can be patient in the market, even if you see your stock price going down by, let's say, 30%, 40%, if you have the stomach to stay in the market, even when you see significant drop in your stock, then you're the type of person who can become successful over the long term. And it takes courage, it takes temperament, and it just takes a lot of emotional strength in order for you to stay in the market. Let's move on to the next rule, which says that you have to know what you own and why you own it. This baby is a cinch to go up, doesn't count. So Peter Lynch is saying that if you own a stock in your portfolio, you need to have a good rationale why you have that stock in your portfolio. Maybe you kind of got into this investment because you like the company and its business model or management team, or you like this company because this company has some competitive advantage over its competitors and peer companies. But Peter Lynch is saying that you can't just buy stocks just because you feel that the stock price is going to go up, or you feel that stock price has been going down over the last 5 years or 5 months, and you feel that this is the bottom. So if you purely look at historical stock price and try to buy into some investment decision, then that's the mistake. But you have to know what you own, what kind of company you own in your portfolio, and what kind of developments you believe that will lead to stock appreciation over the long term. So usually you need to have a good business sense and business knowledge in order to have that stock in your portfolio. Okay, let's now talk about seventh rule. So seventh rule says long shots always almost miss the mark. So let me try to explain to you what Peter Lynch is trying to say here. So whenever you are making an investment, sometimes you know that the probability of your investment success is high because it's so obvious that the stock is underpriced. In some cases, you're not 100% sure. Nothing is 100% sure when it comes to investing, but in some cases, you know that your probability is very high. So whenever you're making investment, I think what you have to do is assess the probability of success for that particular investment. And if the probability of success is, let's say, 60%, then would you have to make investment? I think you have to look other areas for your money to be invested. Because Warren Buffett is saying the similar thing. Warren Buffett said that there's no such thing as strikeout when it comes to investing. You don't have to swing the bat for all the balls coming to you. You can just wait for the right pitch. You can just pass by all the investment opportunities if you believe that they don't provide you high probability of success. You can just pass them by. You don't have to swing the bat. So that's the key message that Warren Buffett has been trying to deliver to people. And also Peter Lynch is basically saying the same thing. Let me just give you some examples. So we had a lot of great undervalued opportunities in 2008 because of financial crisis. Hindsight is always 22. However, if you go back in time, everyone was scared. Stocks have been depressed quite a bit during that time. But if you look at the current time period, 2018, a lot of stocks are overpriced. That doesn't necessarily mean that the stock price is not going to go up more. There's always possibility and room for the stocks to go up in the future. But as a value investor, it's not easy to find great undervalued investment opportunities. In the United States, there are so many great stocks here. Great business model, strong moat, strong management team. But the problem that I have right now is that prices of a lot of these stocks are not at the point where I can comfortably invest. So there's no big margin of safety when it comes to investing in this kind of environment. But if I look around, if I look at emerging markets, I see a lot better opportunities in terms of probability of success. So it's a lot easier for me to make investment decision if I look at emerging markets these days than US companies here in the United States. So that's the good example because I know that there are a lot of good companies in the US, but it's just very highly priced compared to the level that I comfortably investing my money. Whereas if I look at emerging markets like Korea, that's where I came from originally, there are many great companies there that are selling below intrinsic value, and I can invest comfortably there because it's just easier decision for me because of large margin of safety. If you have small margin of safety, then you're going to miss the mark. So try to find out investment opportunities that have large margin of safety. Let's move on to the next rule, which says owning stocks is like having children. Don't get involved with more than you can handle. The part-time stock picker probably has time to follow 8 to 12 companies and to buy and sell shares as conditions warrant. There don't have to be more than 5 companies in the portfolio at any time. So this concept is in line with the concept called circle of confidence from Warren Buffett. And as you can see, there is just a lot of overlap between Warren Buffett and Peter Lynch, and they're all great value investors. So you have to invest your money only in the companies that you understand and you can handle. And if you don't have time to do your own homework and do your own research, don't even bother invest your money. Because as I mentioned, if you want to buy something, let's say laptop, you do a lot of research because you're spending $1,000 on that small gadget. And if you're trying to invest, let's say $10,000 of your life saving, in some cases, you kind of do the gambling. You don't do the research on the pharmaceutical companies that you're trying to invest. You don't even know what kind of products that they're making. Then you're not the type of investor who will be successful in the market. So if you want to be successful like Peter Lynch and Warren Buffett, if you're not a trader, if you're not doing the speculation or gambling, and if you believe yourself as a value investor, then what you have to do is set aside some time to do the research. And if you have 9-to-5 job somewhere else, then your portfolio should not have more than 12 companies. That's what Peter Lynch is saying. Because if you have more than 12 companies in your portfolio, then you're not going to be able to find time to follow these companies and see the developments. And it's just not going to be easy. And just to give you a reference point, Peter Lynch used to have hundreds of stocks in his portfolio because he's a full-time investing professional and he was managing other people's money. That's where Peter Lynch differs from Warren Buffett, because Warren Buffett liked to invest only small number of companies, whereas Peter Lynch had a lot of companies in his portfolio and turnover rate was higher, a lot higher than Warren Buffett. But Peter Lynch was able to do that because he dedicated full time for his investment research. But if you believe that you can make money in the stock market, and if you have full-time job, then just don't go beyond your capability of doing the research on these different companies. So let's move on to the next rule. Next rule says that if you can't find any companies that you think are attractive, put your money into the bank until you discover some. This is awesome advice. Let me tell you why I think this is really great advice, and you should follow this advice if you're a value investor. Going back to the point of overvaluation currently in the stock market, if you're a US investor, I feel that you have to set aside some money in your bank right now. Because as I mentioned, the stock market can go up in value over time, but if you can't find attractive investment opportunities in the US, then it's better to put your money in the bank. Peter Lynch is here indirectly mentioning fear of missing out. Because if you have gone through 2008 financial crisis, and if you had some money back then you probably right now regretting about the fact that you didn't invest your money in the stock market when everyone else has been making money. If that's your case, then you have this thing called fear of missing out. Everyone is making money. Everyone, including people who you think dumber than you, are making money, and you can't handle that situation. You want to jump in the bandwagon and you want to make money. But if you don't implement this value investing strategy in a disciplined manner, then it's better to set aside some money. And if you can find attractive opportunities. So honestly, that's my opinion, and people may have differing opinions, but you only invest in the companies that you know that have good business model, good management team, and also it has to be selling at attractive or at least fair value. Otherwise, your margin of safety is going to be small. I feel like we keep coming back to the same point, but it's important to emphasize the thing that you have to keep in mind as a value investor. And if you have a lot of money right now in your bank account, and if you can't find investment opportunities, just be patient. Or you can look at other places outside of the United States if you believe that US market is overpriced right now. Or you can look at small cap companies and maybe you'll find some great undervalued investment opportunities. But the point that I'm trying to get across here is that if you can't find attractive opportunities, it's okay to put some money in your bank account. Look at what Warren Buffett does. He has tons of cash on the balance sheet of Berkshire Hathaway. Part of the reason why he has a lot of cash is because of the business that he's running, which is insurance business. He has to set aside some money, but he set aside money more than necessary to cover insurance loss. He wants to be comfortably run the business, and whenever there's great opportunity in the stock market, or whenever he has opportunity to buy companies privately, he can use this money, cash, as a tool to make great investment return in the future. So what I would recommend is that you definitely need to set aside emergency fund, whatever amount that you believe is deemed appropriate. And on top of that, set aside a little bit more because it's going to give you optionality to invest that money in case you find attractive investment opportunities in the future, which you couldn't find currently. Okay, I think that's it for today's episode. We went through 9 different rules that Peter Lynch mentioned in his book. What I'm going to do over the next 2 episodes is that I'm going to go through the rest of the rules that Peter Lynch mentioned in his book. And after that, I'm going to talk about some of the techniques that Peter Lynch used to identify undervalued investment opportunities. And before I end, I just want to remind you that 5-star review always goes a long way for this podcast. Thank you very much and see you next time.